Hello there everyone, today's video is all about pre-year end tax planning. So the first in a series of videos that I'm going to do in this month, because we are about a month away from the tax year end, which is on the 5th of April. So today's video concerns individuals who have a salary. So we're not going to specifically look people who have their own businesses, who may be able to manipulate their earnings by paying themselves dividends to reach certain thresholds of income. Let's just assume now for this video it's all about people's salary, and you've got a salary and you pay income tax. But what can you do from a tax planning point of view, particularly around what we call the marginal rates, when the rate of taxation jumps, so the marginal rate increases? So specifically there are several trigger points. Now the first one is 50,000, because as soon as you go over that, that's when you jump up to being a high rate taxpayer. You go from 20% to 40%. The next marginal rate trigger point, 60,000. So, well, in between 50,000 and 60,000, if you are in receipt of child benefit, and you earn up more than 50,000, it starts to get clawed back until you reach the point of earning 60,000 salary. The whole lot is clawed back. So if you earn above 60 grand, you will have to pay everything back that you get in child benefit from the government. So basically it's a benefit that has been around for decades, and a few years ago the government said no, actually people who earn more than 50 grand really shouldn't have it because we think they can do without it. So they claw it back, but they claw it back through the tax code now, through tax returns, through PAYE. So you need to be aware of it if you are earning in excess of £50,000. So again, that's a trigger point between 50 and 60. Next trigger point, if you earn more than 100 grand. So if you earn more than 100,000 as salary, personal allowance is clawed back. So the 12,500 tax-free allowance, that is clawed back if you earn more than 100,000, to the point that once you get to 125 grand of earnings, it's clawed back in its entirety. So that band between 100 and 125,000, personal allowance clawed back, the actual marginal rate of tax is 60% on that. Then after that, the marginal rate drops back down to 40%, and then if you earn more than 150,000, jumps up to 45%. So all these various marginal rate changes, going into higher rate, busting the limit for child benefit, the personal allowance limit, 150 grand. These marginal rate bands, what can you do to plan around it? Because you may say, well, look, if I'm earning 60 grand, I'm earning 60 grand and they're going to claw back my child benefit. Well, there's actually a couple of things that you can do. So the first one is pension contributions. Put money into a private pension. Second one, charitable contributions. Now, they both work in exactly the same way as far as tax relief is concerned. I would suggest most people would rather do the first than the second, but in theory, if you wanted to give 10 grand to charity, it would work in exactly the same way in terms of reducing your tax as 10 grand in your pension. So let's just take an example. So let's start with the individual who is earning £60,000. Let's assume that's exactly 60 grand. Now at that level, the child benefit will be clawed back in its entirety. So what can they do to not have the child benefit clawed back? Child benefit, let's say they got a couple of kids. I mean, that's a couple of grand. So it's not small. It's not a small amount. So, but what they could do is pay into a pension. Now, specifically on that level, 60,000, you are £10,000 above the 50 grand clawback starting point for child benefit. So what you do, you need to pay a gross pension contribution of £10,000. Now remember how that works in the mechanics is that you actually would write a cheque to your pension fund for £8,000. £8,000 is grossed up. In other words, the government will write a cheque to your pension fund for £2,000. So you write a cheque for 8, 2,000 is topped up by the government, and then you claim another 2 grand back from HMRC. So on your tax return. So all in all, you're getting 40% tax relief on that 10 grand. But the beauty of it is, not only are you getting tax relief, but it brings down your relevant earnings as far as the clawback is concerned for child benefit right down to 50,000. So you're still earning 60, but because you've done this gross 10 grand contribution into your pension, as far as the rules work, your adjusted earnings, if you will, which is what we measure the clawback on, is now down to 50. So a very powerful planning tool is to put money into a pension, particularly for those at these trigger points. Same would apply, for example, to someone who is on, let's take an example, and they are on 110 grand salary. But 110 grand salary, their personal allowance has been clawed back. So again, putting money into a pension will reduce their adjusted income levels back down to 100,000. Personal allowance is restored. So it's one of the most powerful forms of income tax planning, particularly for individuals who have got salaried income. That's the bulk of their income, through their salary, and they may say, well, look, we're just getting taxed through pay as you earn, nothing we can do about it. Well, there is. That's what you do. You put a decent wedge into your pension or give some to charity, but you need to do it before the 5th of April. You can't do this retrospectively. So if you're in this boat, which millions of people are, there's somewhere on this spectrum of earnings levels and various bands and tripping over to the next marginal rates, or they might be just over, and then this is how they get back to the rate below, by putting a few quid into the pension. So just the first there on a series of videos around tax planning pre-tax year end. I hope you like this video, and please do subscribe if you haven't already, and I'll see you soon.